individually. So somebody may do something once by itself and it may not be a red flag, but if they do more things more often, then a red flag might go up. So it says, however, when several of them are raised during the origination process, it may be stronger indication of fraud. These red flags include the following. So you might want to just highlight the main part of them, which is steering a buyer to a specific lender. You may be steering them to a specific lender so that you make more money off of them, and they don't want you to do that. Stated income, no doc or low doc loans are required minimum documentation. Most lenders will not offer these programs any longer. So they are offering what's called the bank statement loan, but they're not when they don't ask for actually W-2s and pay stubs. No money due at closing. When a buyer doesn't have to bring any money in, they don't have very much skin in the game, so no money due at closing is a red flag. Highlight sales subject to seller acquiring title. So hopefully the seller owns the property before they try to sell it. I know that sounds kind of crazy, but usually wholesalers don't own the property. Wholesalers are selling the paper. Difference in a sales price. The sales contract is supposed to guide the title agency or closing agent to the terms of the closing disclosure. And sales price changes to fit the appraisal. Related parties involved. They really don't like it when there's related parties involved because a lot of times you're going to sell it to the person for less than what it's worth. Well, of course you are. If you're buying a house from your parents, so I don't know why they have a big problem with that. They think that there's a lot more possibility of fraud when you're buying a property from a relative. Funds paid to an undisclosed third party, cash paid outside of escrow to a seller or to a buyer. You're never supposed to have cash outside of escrow, okay? Over to page 113, mortgage fraud detection and prevention. So the FBI compiles data on mortgage fraud through suspicious activity reports. Highlight suspicious activity reports. One of the questions I've heard of is, who do you report something to if you suspect something? Well, the first person you're going to go to is your manager, and you're going to make a decision if you should do a suspicious activity report. Filed by a financial institution with knowledge of suspicion of fraud and from reports from the Department of Housing and Urban Development. Private subscription services such as the Highlight Mortgage Asset Research Institute, a service of LexisNexis, gives members access to a database of all fraud and suspicious fraud as reported by its members. Drop down to prohibition in predatory lending. I guess I should actually, my thing is not changing for me. And it says, predatory lending. Along with the disadvantages of subprime lending, which extends credit to people who might not otherwise qualify for home mortgages, come some of the inevitable negative byproducts, lenders taking advantage of borrowers. Predatory lending involves loans that take advantage of highlight ill-informed or desperate consumers through excessive high fees, misrepresentation of loan terms, frequent refinancing that does not benefit the borrower. Remember that if you're doing a high cost or a high price loan, you cannot refinance them sooner than 12 months unless it's a really great benefit to the borrower, okay? So there is, you could do it earlier if you're really helping the borrower, but they're going to really look at it with a fine-tooth comb if you're doing it before 12 months. Predatory lending indicators. According to the Mortgage Banking Association, the following are 12 indicators of predatory lending. Steering borrowers to high-rate programs, falsely identifying loans as a highlight line of credit, structuring high-cost loans with unaffordable payments, falsifying loan documents, making loans to highlight mentally incapacitated borrowers, forging signatures on loan documents, changing loan terms at closing. This is a big one, so you might want to put a star by it and highlight it. Charging or requiring credit insurance. One of the questions I saw on that was they said because she was a single woman applying for a loan, the loan officer told her she had to get credit insurance in case something happened to her, and the credit insurance had to cover the loan amount because she was a single woman, and that you cannot do, and that's predatory. Okay. Increasing interest rates for late payments, charging excessive prepayment penalties, failing to report good payment history on a borrower's credit report, and failing to provide an accurate loan balance and payoff information. Next page. Net tangible benefit. So the net tangible benefit is something that came out when the SAFE Act came out, because people were refinancing people without a real benefit. So if you're refinancing somebody and unfortunately it doesn't make any sense for them to really be doing it because they're not saving enough money, the underwriter is going to catch it and go, why are you doing this? You know, sometimes when they're doing a cash out refinance, it doesn't look like it makes sense, but because they're taking cash out, they're using that cash maybe to pay off credit card bills, and maybe in the long run, it's better for them. Yeah. However, you've got to watch out, because a lot of times there's people that will refinance over and over and pay off their bills, and then they'll get more bills and they'll refinance their house, and they're just keeping that vicious cycle. So they don't want to see that. All right. And now we have predatory lending examples. So on the scenarios, you guys can read the examples on your own. You don't need me to babysit you through an example. I'm pretty sure you guys got that. So bottom of page 114, it says, let's see, I want to get in the right place. High cost loans, HOEPA, predatory lending. Let me see, I want to make sure I'm in the right place. Yeah. HOEPA, predatory lending protections. The Homeownership and Equity Protection Act amends the Truth in Lending Act in 1994 and prohibits equity stripping through excessive fees and abusive lending practices related to high cost loans, also known as Section 32. So those of you who asked me to send you or text you something, like if you asked me to text you the fraction chart, I also text, when I text the fraction chart, it's a T, and it says Section 32 and Section 35, and it's high cost and high price loans. And then I have the 1.5, 2.5, 3.5, and the 6.5 and 8.5. Those are the numbers that you have to know for high cost and high price. So if you guys want those, just text me and say you want it. If it's that, I just take it out of my pictures and text it out. If it's the cheat sheet, now remember, the cheat sheet's not mine, but it's a cheat sheet that was given to me by a student, and it's color coded. If you wanted that, I already sent it if you already asked for it. If you didn't get it and you want it, text me your email, because I'm here to help you guys pass. That's all I'm here for.
The cheat sheet, it helps you pass the test, or it helps you explain?
The cheat sheet helps you understand the different laws, because it'll say like truth in lending, and then it'll have the key provisions of it, and they're all color coded.
Okay.
Okay. And you cannot print it, okay? So first of all, you're gonna open it and it looks like this colorful thing. If you wanna print it, I've had students put it on a fob and go to like FedEx and go ahead and print it. So it's not something that you can copy either, because it's a young lady who did this whole thing, and then she shared it on a Facebook study page. And so it's all people from Affinity Mortgage School, and Affinity is because they're still teaching it, but their main instructor, who would be like equal to me, she passed away. Okay, and it wasn't from COVID, it was from a pre-existing COVID issue. Like she had like a lung problem or something. So it was really sad, because she was really good. And she does have some videos out there. However, Affinity and her videos are dated. Okay, so she passed away last November, and they had changes back in April of this last year. So that's why I always tell you guys, make sure you're studying the updated stuff.
My cousin took Infinity, and she took her test last month, and she got a 74.
Oh, she missed by 1 point.
Yeah.
Oh, tell her to study my stuff. Yeah. Send her to my emails. Send her to my, what's it called? My YouTube channel. Okay. Anyway, back to work on this. I think we already talked a lot about MARS. MARS is the mortgage relief that comes with people who are losing their house on modifications. And when they're trying to do a modification, these companies would try to collect money from them up front. The main thing about MARS is highlight a ban for accepting, it says, money before they got a written offer. So it says a ban on those who provide mortgage foreclosure, rescue, and loan modification services from collecting a fee until they have a written offer from their lender. That's the main thing about MARS. Just remember how I remember that it's the mortgage relief. As I go, if you can't afford your house, you have to live on MARS. Okay. The next thing is requiring that mortgage relief company to disclose key information to consumers to protect them from being misled. I would highlight misled. A prohibition against making any false or misleading claims about the mortgage relief services, such as providing any type of guarantee, because you can't guarantee you're going to get them a modification. And prohibitions bearing the mortgage relief company from advising consumers to discontinue communication with their lenders.